Good afternoon, everybody. Today is Zoom at 8. We are here every Tuesday, so thank you so much for joining us. My name is Julianne Peterson. I am your host today. I am with Old Capital Lending. We are a premier provider of debt on many different asset classes. However, most of our focus is on multifamily. We close $1 billion a year. So if you guys are looking for first and foremost debt, but if you are looking for equity or you're looking for sponsorship or you're looking for LPs, we are a great resource for that. So make sure you reach out early. Let me know how I can help you. All right, so without further ado, let's push it over to Chris. You guys, we have 45 minutes to listen to Chris and ask questions. Chris has been with us several times. We think he's like peanut butter. You just want to spread him around. He is just so knowledgeable of different markets. He is an editorial director for Yardi Matrix, and he is responsible for overseeing market research and data analytics, as well as editorial composition for Yardi Matrix, commercial property executive, and housing, multi-housing news. He facilitates the expansion of the Yardi Matrix reporting suite and provides in-depth analytical tools for clients across the commercial real estate industry. His focus includes data analytics and reporting for not only multifamily, but office, storage, industrial, those asset classes. So before joining Yardi, Chris served as a portfolio manager for the Bank of New York Mellon. He managed fixed income portfolios for municipal and public sector clients across the United States. He holds a bachelor's degree in economics and a master's degree in finance. Both of these are from the University of Denver. He is located still in Denver. It hasn't started snowing yet. So Chris, I'm so excited to have you here. It's just such a pleasure. You're just so smart, and I love that you share, and you're so generous with your information. So I'm going to go ahead and turn it over to you, and we'll hold our questions until the end. Does that sound good, Chris?
Yeah, that sounds great. What I'll do, Julie, I'll share my screen here. And I've got a couple of slides to go through on the Greensboro market, as you mentioned. I understand we've got a couple of North Carolina investors on the call tonight, so that's great. Please feel free to tear my viewpoints apart or agree or somewhere in between. But it's great to have people with boots on the ground knowledge of the markets that we'll be talking about as well. As you mentioned, we did a poll last week. We were talking about markets and what was going on. We did a poll, and Greensboro was the winning market. I think the markets of choice were Portland, Maine, Boise, Idaho, Greensboro, Chattanooga, and one other market that I don't remember. But the point being, we're talking about Greensboro tonight. So I'll go through a couple of slides talking about the data that we see in Greensboro. And then what I'll do is I'll open up the Yardi Matrix data platform. I know a number of you who've heard me on this call before have heard me talk about the data platform. So I'll open up our subscriber portal and show you how I look not only at markets and submarkets, but how I look and go find deals and contact information. We can go through that. And then, as Julie mentioned, there'll be a breakout session at the end.
Cool.
So without further ado, let's dive into Greensboro, North Carolina. And just for a little reference, our Greensboro market includes the Winston-Salem market. So Andy, I know you were working on a deal in Winston-Salem. So the Greensboro, Winston-Salem market, in our view, is one collective market. You may have a little bit more inside knowledge and might tell me that Greensboro and Winston-Salem are completely different. But for this purpose, we'll show the data as aggregated. But starting with rent, the Greensboro, Winston-Salem market had really been lagging behind some of its peers, Charlotte, Raleigh, the national average, at the beginning of, or I should say the middle of the last cycle, 2015, 2016, when some of these secondary markets were really running hot. rent growth was about 3%, 3.5%, not bad by any stretch, but lagging behind its peers. But then if you look around the middle of 2017, right in here, the Greensboro market really shot up as a lot of the supply started to drag down rents in Charlotte and in Raleigh and across the nation. And look at this dark black line, that's Greensboro. It's really beaten its peer markets for the better part of the last 3 or 4 years. And if you focus on the post-pandemic performance, well, Greensboro is really just kicking butt. Like the national average and many secondary markets, we saw rates, year-over-year rate growth or rent growth fall close to zero in a lot of the bigger secondary markets. And for those who weren't on the call last week, when I talk about bigger secondary markets, I'm talking about Charlotte and Raleigh and Denver and DFW and Atlanta and Phoenix and Orlando. The primary markets are New York, San Francisco, LA, Chicago, Boston, and DC. The bigger secondary markets are those that I mentioned, kind of about a million to 2 million in population. Then the tertiary markets are below that. So Greensboro, I would consider a tertiary market. It might be a secondary market within North Carolina, but I would view it on the national average as a tertiary market. And what we were talking about last week and what we've seen is that these tertiary markets have really been the ones that have outperformed since COVID really started to drag down the economy. And again, you see it right here on a year-over-year rent growth. Greensboro, Winston-Salem has maintained rent growth above 3% through the pandemic. Huge delta in rents and rent growth right here compared to the national average and compared to its peer markets. So another one of those tertiary markets that's really doing well. Looking at occupancy, again, Greensboro, the darker black line, the thicker black line, really lagged below some of its peers until about a year or 2 years ago, and it started trending upwards. As the other markets have been steadily trending downwards over the last 5 years, Greensboro has been volatile, but for the most part trending upwards. And again, look at where we're at now. The Greensboro, Winston-Salem market above 95% occupancy. That's very, very strong compared to where other markets are in kind of the post-pandemic or mid-pandemic world that we're in right now. Really, really good fundamentals going on in the Greensboro, Winston-Salem market. The deliveries as a percentage of stock, and what we're going to look at here is the trailing 12 months delivery. This is probably the best metric that I would recommend people look at in terms of new supply. Now, a lot of us are probably B and C class workforce investors, but that doesn't mean that new supply won't weigh heavily on the overall market. When you look at the Charlotte market adding 6% of existing stock back in 2017, Raleigh-Durham adding 5.5% of stock back in 2015, those are really significant deliveries and really significant supply numbers. If you look at the red line here, that's the national average. Construction usually stays around 2.5%, maybe it'll bump up to 3% of stock over time. But I generally like to see that kind of 2.5% range as a pretty healthy barometer. Obviously, the more supply you have, you're going to need more demand in order to keep things stable, in order for prices to stay stable and prices to rise. Demand we'll talk about in just a minute in terms of domestic migration and household formation. But overall, supply tends to be an inhibitor of rent growth for multifamily if there's a lot of supply. Again, one of the arguments for Greensboro is that they haven't had a lot of supply throughout this cycle. Yeah, they were up here at around 3%, but they dipped down below the national average, oscillating around that 2% line, back up to about 2.5% today, but still delivering far fewer units on a percentage basis and on an absolute basis than their peers in Raleigh and Charlotte as well. And so the final fundamental that I'll kind of talk through is the average rent, right? Obviously, at the end of the day, what can we rent our apartment units for? That's one of the key questions that we'll be asking in order to drive performance and drive rent. We want to see those rents going up. And for the most part, we've seen rents climbing pretty steadily throughout the cycle. As I mentioned, around March when COVID hit, we started to see, certainly in the primary markets and the secondary markets as well, those rents start to come down. Tertiary markets have stayed pretty strong and in fact showed a little bit better growth. But the trend line is less important here than what I would say the delta is. So the average rent in Raleigh-Durham is somewhere around $1,200. Similar in Charlotte, the average rent across the country is almost $1,400. Look where it is in Greensboro, Winston-Salem, just under $800. So when we're talking about a market that's attractive to not only continue growth, but to bring in people, we want to look at affordability. And so we'll talk about migration, we'll talk about the growth in Greensboro, but one of the big things is that it's remained an affordable market compared to the national average, compared to its peers, and as a result, it's seen very steady rent growth. Rents continue to climb over the past 5 years. So overall, I know this is kind of a quick snapshot, and just a reminder, Julie will have these slides and the recording will be available as well, but I'm happy to share the slide deck. Julie will have the slides as well, and she can share them for anyone with questions. But really, as we go back through it, the real estate fundamentals in Greensboro are quite strong. Now, we talked a lot about domestic migration last week. A huge driver of rent growth, a huge driver of demand for apartments in secondary and tertiary markets especially. For those who weren't on the call last week, I talked a lot about markets like New York and Boston, San Francisco, Los Angeles, where people are fleeing the market. They're either going to the suburbs right outside the city that they're already in, or they're packing their bags and saying, you know what, I can live in Raleigh-Durham for half the price or a third of the price of downtown Manhattan. I can live in Dallas for a third of the price of San Francisco or LA. I'm going to make that switch. And those are all people who are migrating domestically. They're moving out of one market and into another. So when we look at secondary and tertiary markets, I focus a lot on this domestic migration. And you see here that the Greensboro domestic migration, this is 2018 to 2019. Greensboro domestic migration was just under 10,000 people. Now, certainly lower than Charlotte, lower than Raleigh. So it's not booming from a domestic migration perspective. But one thing that I would encourage you to do is look at the size of these markets as well. The Greensboro, Winston-Salem market will be smaller than both of their peer markets. And while it's not topping the charts, still pretty strong domestic migration numbers. I was just chatting with Julie before the call. It seems to me, and Andy and Brady, I'd love your input here on what you're seeing, but it seems to me that Greensboro, Winston-Salem are a little bit more of the retiree or the baby boomer market within North Carolina, where the millennials seem to be going to Raleigh, seem to be going to the Durham, Raleigh Research Triangle. If they're on the financial side, they're going to Charlotte on the banking side. So again, not overly concerning about the slightly weaker numbers on domestic migration in Greensboro, but again, overall, North Carolina is really, a hotbed for domestic migration coming out of the Northeast, coming out of the Midwest. Great quality of life, low cost of living, generally a low cost of doing business, mostly a business-friendly state. So again, really, really pretty strong demand dynamics across North Carolina as well. So just to wrap up, again, Greensboro has consistently outperformed its peer markets in North Carolina and the national average. When we're talking about rents, we're talking about occupancy, we're talking about less supply, and we're talking about absolute affordability. Again, rent growth has been stable and strong through the pandemic. If you've got a market where you've either continued to grow through the pandemic or you've even just flatlined and had moderate growth, you're doing very well. We talked a little bit last week about the impact of interest rates and how the lower interest rates have really boosted values. Now, if you get fundamental growth on top of value growth based on interest rates, well, then your properties, the values of your properties are just shooting through the roof. Julie can certainly talk more about the interest rates than I can, but if if you've got strong and stable growth throughout the past 6 or 7 months, you're in great shape. Affordability, again, remains attractive in Greensboro, and it continues to bring people into the market, Greensboro, Winston-Salem. And while the domestic migration lags, it's only lagging slightly. And again, if we were to look at markets across the country where there's a lot of negative domestic migration, domestic out-migration, in the big primary markets like New York, LA, and San Francisco, and even smaller markets, Baltimore, New Orleans has some weaker domestic migration. Some of the Midwestern markets, I know Cleveland, Cincinnati have negative out-migration. So overall, North Carolina, specifically Greensboro are really, really good places to be right now. So with that, I'll kind of just wrap up. And at this point, I'll take a quick pause and open it up to any questions that people have before I kind of jump into our data platform and how I search for deals. Any questions?
Yeah, I think you're about to get into it, but I was going to ask you about your services.
Okay. Yeah, I will jump into that in just a second. Any questions about kind of the overall market fundamentals or any of the metrics that we went over? Andy, Brady, any confirmation or outright denial?
Yeah, so and I would agree with you that it does seem that it's a pretty balanced market. It doesn't seem like any one industry is taking over that area. There's a pretty strong healthcare contingent. But I am curious, isn't it too early to say really whether the rents have been, propped up by, whether it's additional, assistance? Isn't there a world in which tertiary markets could really get slammed here? And what do you think the likelihood of that is? Or maybe you feel like it would be sooner that you'd see B buildings suffering. I mean, I was talking with Jerome today about just in general people liking the B building. But give us your thoughts on that. I'm just curious.
Sure. Yeah, and you're absolutely right. There is still concern over market performance and deterioration in fundamentals. Going back to March, we expected to see significant rent declines, significant occupancy declines at the market level and at the national level. Certainly the additional stimulus, the CARES Act, the additional unemployment benefits kind of buffered us through the summer, through July 31st when those benefits expired. Maybe people had saved up a little bit for August, maybe even a little bit for September with some of the additional unemployment. We continue to see very, very strong collection numbers. If you look at the NMHC collection reports, if you look at some of the individual collection reports, the information is very, very promising and to be honest with you, a little bit surprising. I would have thought that not only once those unemployment benefits had expired, we'd see a deterioration, but even more so, given that we've got such volatile economic footing right now. What I would say is that...
Go ahead. Sorry, I thought you were finished.
No, go ahead, Andy.
I would say now, knowing what you do, is there any explanation for that? I mean, it still doesn't make sense to me that people are paying rent in the way that they are if they're not back at work, or if they're back at work for, half of the hours that they were before. Is there any explanation? Is it inflation? Is it that there's so much money throughout the economy that they're getting help with? What would you, if you could backtrack it, what would you attribute that to?
Yeah, and I would probably attribute it to a couple things. One is that of the owner operators that I talk to, big owner operators, the REITs, all the way down to mom and pops, the general sentiment as soon as COVID came out was, we're going to do what we can to work with our renters. If that means putting people on payment plans, if that means working through whatever they can do financially, there was a concerted effort to do that. I know there was a number of eviction moratoriums in place as well. Some are still in place, some are beginning to expire. I think that's part of the reason why you're seeing fundamentals stay as strong. That both the tenant sees the value of the landlord working with them, and the landlord sees the concern over not only negative publicity, but trying to fill units during this time as a little bit difficult. That's one factor. A second factor is you absolutely are seeing deterioration in more expensive markets and more expensive submarkets of less expensive markets. So I talked a little bit about New York and LA. Those rents are cratering, 10%, 15% year over year drop in rents. Absolutely. Occupancies are cratering in those markets. The downtown urban core, which tends to be the most expensive submarket within a secondary market. You're seeing that in downtown Denver. You're seeing that in Buckhead in Atlanta. You're seeing that in kind of uptown Dallas, Austin as well, parts of downtown Austin. So you are seeing it in pockets. And what I'd say is that the affordability is really starting to speak volumes in some of these tertiary markets where the overall level of affordability as a percentage of income for just the median rent and the median income is much more affordable than it is in some of the bigger markets. And that's why I think you're seeing the outperformance in some of these other markets. Perhaps people who lost jobs were able to save a little bit. Otherwise, if you're able to go back to work, you might still be able to pay your rent on reduced hours or reduced paycheck. Generally, the affordability of these markets is helping them power through.
Maybe I just one thought is that, at least in my mind, a lot of renters by need as opposed to renters by choice often tend to be in essential working positions. And so some of those people, although some people are out of jobs, that cohort might actually be more highly employed than some of the other industries that are impacted, regarding retail and hotels and things like that.
Yeah, Chris, that's a good point. And I would also add, kind of to the counter of that, being that there are a lot of service workers in some of these workforce housing B and C class properties as well. So while you're right, the essential workers do make up a large renter pool for a lot of our properties, we might also be seeing, especially in that workforce housing, significant number of tenants who have experienced job loss from the services sector. And Andy, one more thing to add, I think to your point about could we still see a fall off in tertiary markets? We absolutely could. Thus far, these markets seem to be the ones performing the best. But the longer that the pandemic lasts, the longer it takes for us to get a vaccine. If there's volatile exception or adoption of the vaccine, then yeah, we could see a deterioration in fundamentals. But I expect to see that take place mostly in the densely populated cities, in the densely populated submarkets of smaller cities, and then finally it'll trickle down to the tertiary markets.
Thank you.
Yeah. And any other questions before we kind of jump in?
Hey, Chris, it's Chris Dow. Always appreciate your insight. Quick question. So as we look at Q2 and Q3 of next year, two categories I'm curious about. One, distressed properties, and two, opportunities. Where do you see Q2, Q3 of next year? Distressed property will most likely appear in which cities, and where are the opportunities to buy in other cities?
Yeah, great questions, Chris. And I think those are the questions that are on everyone's mind right now. And I hope no one on this call goes back into Julie's library of old calls, because I remember it was either May or June when I was on the program and we were both saying, get ready, the distress is coming. Where are we going to be finding these cheap deals? Line up your equity and debt and let's go.
I remember that.
Yeah.
Okay, good. Call me out. I'll be the first one to acknowledge that. What I think we're seeing, and this is the result of the Fed and the fiscal stimulus really doing its job. So the Fed came in with a number of credit facilities, a number of liquidity facilities, and their goal was to backstop assets, backstop real assets, real estate, backstop the equity markets, stocks, backstop bonds. And if you look at the S&P or the Dow, we're back to where we were right at the start of the pandemic. If you look at what's going on in real estate, they've done a good job and by manipulating interest rates and keeping interest rates where they're at and lowering interest rates. The 10-year has certainly come down. I know back in April, May, June, Fannie and Freddie had put on a couple additional covenants that are starting to expire, or they hadn't really moved their cost of borrowing down. But now, and Julie could certainly tell you better than I, but cost of debt is cheaper than it's ever been. In all likelihood, cheaper than it ever will be. And what happens when you lower those interest rates, even if your fundamentals are declining, your ability to refinance or your ability to buy at a lower borrowing cost keeps your cap rate and keeps your valuation pretty stable, right? So if your NOI goes down and your borrowing cost goes down, those kind of offset one another. That's what's happening in New York, in Chicago, in LA, in San Francisco. Valuations are just kind of staying steady in those markets because the cost of debt coming down is offsetting the weakness in occupancy and NOI growth, et cetera. If you flip that around, though, and you look at markets where fundamentals have just been steady and NOI has stayed the same, and you still get that benefit of the lower interest rate, the lower cost of debt, well, your value's actually gone up. And we have done a couple of studies in Raleigh and Dallas and in Denver where valuations of the past 7 months have actually increased. And again, I was one of those people saying, there's going to be buying opportunities. There's going to be buying opportunities. Is it going to be 10% of a discount? Is it going to be a 20% discount? What's it going to be? Right now, we're seeing 2% discounts, flat, pretty much no change from pre-COVID pricing. And then again, in these tertiary markets where fundamentals have actually increased and gotten better, rent growth is higher than expected, occupancies are up, NOIs are up, and you also get the benefit of that ability to refinance at a lower rate or buy in at a lower rate. Well, then those values are really going to climb. So Chris, unfortunately, I'm here 4 months later to say that my early prognostication on distress doesn't seem to be coming to fruition. I'm not going to predict again, because if I predict again, I know I'm going to be wrong again. But what I'll tell you is, if we see a deterioration in fundamentals the way Andy was talking about, we may start to see distress down the road if we see a deterioration in fundamentals. There's not a whole lot more, in my opinion, that the Fed can do to really mess around with interest rates and keep the borrowing costs lower than they already are. So they've kind of used that. They've played that card already.
But Chris, so to kind of follow up, right? One of the city I'm looking at is Las Vegas. There's no fundamentals there. Some of the people I talk to, casino are open at 50% capacity at most. Bars and other entertainment industries are not even open at all. So there's no other business other than casino in Vegas. So I would imagine there's a lot of distressed property coming up in Q2 of next year. Is there other cities like that you see?
Yeah, so Chris, I would totally have agreed with you about Vegas, and Vegas was another market that we were watching for a lot of distress. Our data actually doesn't show a deterioration in fundamentals. And again, that's kind of a head scratcher for me, what's going on, because as you said, the casinos are closed or at half capacity, the bars, the restaurants, the theater, none of that is operating. The conference scene, so much of Vegas was, big, huge conferences filling up those hotels. Those aren't taking place. My only insight into Las Vegas is that there is very strong domestic migration, leaving San Diego, leaving Orange County, leaving Los Angeles, leaving San Francisco, and going to the cheaper alternative, which is Las Vegas. That is kind of the only thing that would make sense right now as to why we've seen year-over-year rents increase in Las Vegas. Occupancy stays stable in Las Vegas. And again, what's leading me to believe that is that our discretionary asset class, the luxury units that we track, are doing better than actually the workforce housing in Vegas. That's one of the only markets in the country where that's happening. As you would expect, the workforce housing that's housing all of the casino workers, the hotel staff, and the restaurant staff, that section is actually struggling. It's the luxury units where people are, giving up a one-bedroom studio or a one-bedroom or a studio in LA and moving into a 3-bed with 1,500 square feet, practically the penthouse in Vegas for half the price of what they used to be paying. And those are the units that are really doing well in Las Vegas.
Okay, that makes sense. Thanks.
Hey,
Sure.
Chris, I think you did an amazing job with the presentation. Just wanted to add a little insight on what I'm seeing on the ground in case everybody's ready to invest in Greensboro now. And I guess I'll start with the point that Andy raised. So I think there are two things happening right now. I think there's really two economies. Whoever's got money in Wall Street and seeing their 401ks and regular investments and brokerages going up, they're experiencing one economy. And then there's a whole nother group of people who are struggling and suffering. And there are all of the different housing agencies that are providing support for people who've lost their jobs through COVID or been displaced in some other way, shape, or form, and legal aid, kind of camping out in the different courthouses, or helping people stay in place without the property owners collecting rent. So I think between now and the end of the year, we're going to start seeing a degradation of actual collective rents and people not being able to cover that up. And I think that's what's happening in some places. People are collecting things, and I'm not quite sure how they're reporting it, but I do think I don't think everybody's being transparent with the impacts, because when I sit on the calls with the people who are providing support to the folks who have, workforce housing or they're unemployed and so on and so forth, they're talking about being overwhelmed and how their call volume has quadrupled and have multiples of 5 and 6, and they can't process all the applications quick enough. And oh, by the way, they can only provide so much money to cover those folks who haven't paid rent for 3, 4, 5, 6 months in some cases. We've had several people in our properties skip, and they've had large balances. Probably the largest that we've seen in one unit is probably $6,000. So I think there's a lag in the data, and I just want people to be careful, because I got presented a deal today. It was 300 units, and they're looking for pricing between 85 and 90 grand for a 70s build here, and they wanted to sell it at a 4.5 cap. And for me, I can't count that high. Like, it just doesn't make sense. I'm building new for not much more than that, and I'll be able to lock in our HUD loan at sub 3% money. So just be really careful on your value add deals. If you think you can buy something, raise rents, you just don't want to grab a falling knife. And I do think the distressed deals are coming. I just think we're early. I think people have been able to weather the storm because things have been going well and they have some cash in the bank. But I do think that the hammer is going to drop. And I'm not quite sure when, but I do think it's going to drop. So I don't think you were wrong. I just think you were early.
Yeah, well, Jerome, thanks. That's good insight. I love hearing, about people who are actually owning and looking for deals and building deals. Does anyone else have any insight on collection issues in your own deals? Are you seeing more and more collection issues coming to fruition, or are you seeing collections stay pretty stable?
Hey, this is Jonathan New. My collections have actually improved over the past few months. We peaked at like a 10% delinquency rate, and ever since then, the tenants have developed a plan on their own to get current and get to this right now, I've got one tenant at 159 that just hasn't paid.
That's a C class, Jonathan?
Yep.
Jonathan, I'm curious, because we had some problems and we were able to pay cash for keys much more than we had budgeted for. Luckily, we had reserves on some buildings in Fresno, and others we just decided, hey, let's sell. And we sold one building. I was telling Jerome, 18 units. We sold it a week. It was a 10-day close. Asking price. I was asking what was under the building. So that's the other thing is, like, I haven't seen values change much, or at least activity change much. But yeah, we weren't 100% on our collection, and we knew in California, which I understand is its own, crazy place. But we could, even if we did evict somebody, the courts would be backed up for months. So we're talking like tenant could feasibly sit 10 months without paying, and that's kind of why I understand what's being said. It just does seem like maybe it's just anecdotal, and maybe there's enough market forces, people coming into multifamily from other asset classes that are kind of propping up values, and that there's more demand. There's still tons and tons of supply issues at many of these places. So if you can get a tenant out, then you should be able to get somebody else in. But yeah, I've talked to some operators that aren't, and maybe they bought in the last 2 or 3 years. A couple of those properties are fine because we got enough cushion, but that's been our experience.
Yeah. Well, I know for some of the properties I talked to in Texas, so I talked to brokers as well. Couple of the broker told me is that there are more in the last 30 to 45 days property up for sale because some of these sophisticated operators are trying to hedge the election, good or bad, right? And then you also have forces from international money that is coming in at a cheaper cost of capital, buying, coastal type of property. And then lastly, if you look back since March, government's been printing money. So a lot of these deals that I get, the T12 hasn't really changed much. The NOI has been pretty stabilized because of the government subsidies. So as Chris pointed out, the cost of cap debt is so much cheaper. So a lot of these deals can ask for a premium and still pencils out, right? I think Q2 probably is the magic. I know San Antonio, they just announced, I think it was the government or the city of San Antonio or Texas. No, it was Texas. Texas just announced something like $10 million of rental subsidies. So if you're in a Texas market, look it up. If your tenant qualifies, you're good for 6 months. The government will pay 6 months of rent for you. So that's what I keep thinking Q2, Q3, because a lot of the operators that I talk to, their NOI is being propped up by the government, one form or another.
Yeah, and Chris, just to add to that, I'm certainly not a political pundit, but what I would say about the election is that regardless of who wins, there will likely be another stimulus package after the election. If Joe Biden wins, if there's a strong sweep of Democrats in the House and the Senate, there's going to be, or there will likely be, a large stimulus package. But if Trump wins, if Congress remains split, I do expect there to be some connection between Pelosi, Mnuchin, Trump, and all of their camps, north of $1 trillion. And a lot of that will go to either unemployment. The NMHC has been lobbying hard for direct rental assistance, direct stimulus checks. So while that won't necessarily be the panacea for the economy and the virus, I do expect there to be additional stimulus coming in November, December, January, really regardless of who's in Washington. The party in charge will likely determine if it's another huge stimulus or if it's a smaller stimulus, but I do think there's going to be another stimulus package likely before the end of the year.
Hey, Chris, I got a question. Somebody was asking about are you seeing distressed deals in Houston at all?
Not really, and in fact, we're not seeing distress in many places at all. Houston continues to be a resilient market. We're finally seeing the construction pipeline slow down a little bit in Houston. It seems like we've been building 25 to 30,000 units a year in Houston for the past 10 years, and we're finally starting to see the development pull back. Houston's an interesting market. It certainly has some environmental risks and some environmental concerns, but it continues to add jobs at one of the highest rates in the country. It continues to pull in domestic migrants. Harris County, Houston, DFW, and Austin as well are always seemingly in the top 5 of the top 10 for domestic migration, for population growth. So while Houston, the fundamentals, because of all the supply, rents haven't ever been growing by leaps and bounds. Occupancies remain pretty stable, 92, 93, 93.5%, a little bit below that national average, again, because there's so much supply and seemingly always more and more and more supply in the Houston area. But yeah, we haven't seen a ton of distressed selling quite yet.
On those graphs that you shared with us, were those A, B, C? What was the breakdown on those classes?
That was the whole market. So we pulled all of the market together. I'd be happy to pull some A versus B versus C data if anyone would like to take a look at it. But the graphs that I showed were all aggregated at the market level.
Okay.
Chris,
Now,
sorry.
Yeah, go ahead, Chris.
I was going to ask if Yardi tracks personal debt and if there's been an increase in that for renters.
We don't. No, we don't track individual collections. Okay, great. So let me share my screen again, and we can go ahead and get started. So this is kind of just our main home screen. And so when I'm looking at a new market for the first time, what I like to do is just get a visual overview of what the market looks like. So we're going to go down here to Winston-Salem and Greensboro, and I'm just going to do a quick search on the whole market. And of course, I need to log back in. But what this map view is going to show me geographically, how is the market laid out? Are there coastal barriers? Are there rivers, lakes, highways, anything that would kind of impact the market? So I'm going to zoom in a little bit, and I see that most of the market kind of runs east to west. So we got Winston-Salem over here, more of a densely populated area for multifamily. We got Greensboro over here. Sorry, we got Greensboro right here. And then we've got kind of this little pocket over to the east as well. So got a kind of a pretty good visual of where the market looks like. Now across here, it's currently sorted for property asset class. So as I mentioned, discretionary. Those are the green dots that you see, the luxury product, and all the way down to fully affordable. So it looks, and I know there's a ton of little pin dots here, but it looks like there's a pretty good mix. Not too many discretionary, not too many luxury properties, some upper mid-range in the dark blue and low mid-range in the light blue. And then you got some of these orange properties, yellow properties that are your typical workforce asset class. So this drop down, I can also change to a number of these different filtering locations. So I'm going to do the property status. Green is a completed existing facility. Under construction are the tan, planned and prospective, or your pre-construction phases. So what I want to do here is I want to say what's in the pipeline. So I see a lot of perspective, a lot of these blue dots, a lot of red dots over in Winston-Salem. Not a ton under construction. I got one deal here. I got one deal here under construction. One over here in Winston-Salem. Another one. Again, a little bit more development activity as we move over to Greensboro. But all in all, as I mentioned in the presentation, not a ton of development going on right now in Greensboro. Generally a good thing when we're looking at market dynamics for existing owner-operators and the ability to increase rents over time. You can look at a number of different metrics. You can look at the current average rent. The darker the blue, the higher the rent will be at the property level. You can look at property age. So if you only want newer buildings, you can kind of search for that. And each of these, I should have mentioned, each of these little pin dots is a property. So you can click on any of that and it'll take you right to the property report, and you can go from there. I'll jump into the property report in a little bit, but the next thing I want to show is, how am I going to pick my submarkets, right? I've identified Greensboro, Winston-Salem. Now I want to know where within the market I should look. So I'm going to go to my reports. I'm going to go to the rents and occupancy, and I'm going to go to the rental market trends report. I'm going to pick Winston-Salem, Greensboro, and then I'm going to run this report, and we can look at the past 4 years. Let's look annually, and let's break it out by submarket. Okay, great. So this is going to show me the 4-year rent change in all of these submarkets. So, all right, we see 20% here, 23%. That's pretty good rent growth. 25%. Oh, Hamilton Lakes 36.5%. That's been pretty good rent growth. Burlington East 22.6. So let's just pull out a handful of these submarkets that look good. Hamilton Lakes is one of them. Let's do Peace Haven, Bethabara. Let's just start with those 3. So I've identified the submarkets that I want to go to. Strongest rent growth. Now that doesn't obviously mean that it will be the strongest going forward, but they've had pretty good rent growth over the past 4 years. So now I'm going to go into the residential report, and I'm going to go to the property type advanced. And one thing I'll just say really quickly, I know I'm kind of going through this fast because we're on a time crunch, but it is recorded. Julie will share the recording. Please feel free to go back, watch the recording. If you have any specific questions, you can always reach out to me. You have my contact. Julie has my contact. I'll share it again before we wrap. But yeah, watch the demo again and reach out with any questions. But here is kind of what I like to call our big sandbox. It's got the most filterable options. So what we're going to look for here is a list of properties. And we're going to include the owner-manager information because we want to have their phone number and their address when we find a deal we like, whether it's already on the market or off market. This will give you the owner's contact information. So you could either pass that to your broker, you could bypass the broker completely and say, hey, Bill, I want to buy your property. Here's how I found your information. So we're in Winston-Salem. We're going to go to Bethabara, we're going to go to Peace Haven, and we're going to go to Hamilton Lakes, right? Those are the 3 submarkets we chose. And again, let's just kind of start here. Again, since I don't know Greensboro, Winston-Salem, the first place I might look is a map view because I don't even know where these markets are, these submarkets are. So I'm going to take a look at the map. Are they close to one another? Are they in different markets? Okay, so we've got kind of the Bethabara submarket up here. We've got Hamilton Lakes over here by Greensboro. And then we've got Peace Haven down here. Again, you can see a good mix of upper mid-range workforce properties. You got one discretionary, one luxury deal over here. But this is just kind of all of the inventory in these markets. So I'm going to go back to the report. And again, if say, I just want to pull off all of the deals in these 3 submarkets, great. I've got the report right here. I can export it to Excel, and all of this information will get pulled down into a neat and tidy Excel file. that I can then play around with and manipulate to my heart's content. Again, it'll have the owner's information, Ray Ventures, William Ray. It'll have his phone number, his address, same with the property manager's information, unit count, square footage, when it was built, property ratings, and so forth. But let's say I want to refine this just a little bit. And I only want properties maximum 150 units, and let's say 1990 to today. Again, this might not render any results. It might render the same list, but let's just play with this a little bit more. Okay, so now we're down to 8. So if this indeed is my search criteria, well, this is probably a good number of properties to really dig into. I know the submarkets I like. I know the vintage 1990 and recently, and I know it's got a maximum of 150 units. So let's kind of jump into a property now. I want to check out this Abington Gardens. Sounds like it'll be a good deal. So I can go in and I can see, well, of course, the one that I picked is probably not the best example because it's fully affordable. So let's go back to the property type advanced. I should have caught that. It's right here. It says fully affordable. But let's keep going. Villas at Peace Haven. This should be a good one. So again, this is our property record. We see the owner, BSC. BSC is also managing it. Again, right here, direct contact information, and I know I want to talk to Barry Siegel. He's the owner, or he represents the owner, and we can get this information by piercing the LLC. Many of you know, and many of you, I'm sure, own properties in LLCs, but one of the things that our research does is it goes below the LLC level, so we can get a specific contact and that contact information at every property. We see its completion year, we see its occupancy, its address, a couple pictures, and then we get into kind of the nuts and bolts of the property. We see the unit mix, unit sizes, and what the rent is on a per unit and per square footage basis. We can see what the debt service coverage ratio is. We can see what the current loan is. There hasn't been any recent sale of the property, but if there was a sale of the property, we'd be collecting that too. We can look at an occupancy trend. We can see, okay, this one's trending down a little bit over the past year. It's actually lost about 7% occupancy. So might be an issue there. Is he going into a value add? Is he mismanaging the property? This is a very interesting data point because you can say, again, you can call, I think it was Barry Siegel, and say, hey, I see you're struggling with occupancy. What's going on? What's going on in the market? Might add to your leverage if you're interested in going after the deal. Historic rent information, you can do it by month, by quarter, by year at the unit mix level. And all of this information, again, is exportable into Excel. So you don't have to just be working through it on the web browser. Anything can be exported into Excel, plugged into your underwriting models, and you can go from there. And then finally, it'll bring you to the property characteristics. So this facility or this property has a fitness center, business center, tennis courts, pools, garage parking. You can see kind of all of the characteristics of the property. And finally, you get into the demographic information. So right now, I've got it set to a 3-mile radius. What's the population? What are our population growth projections? Income information, home ownership information, job information, average rents in the area. So this property has rents that are a little bit higher than the average rent. And so again, all of this is valuable when you're going into your underwriting. So I know we've just got a couple minutes until my time is up. But again, want to just go back and
hey, Chris, can I ask you a question? There was a question
Yeah, Julie, go
about
ahead.
why fully affordable, why are we not looking at those? What's your thought about that?
Yeah, so I'll open up this Abington Gardens. Because of the way fully affordable properties run, it's very difficult for us, and in many cases impossible for us to get rents. So for a fully affordable property, we have a lot of the same information. We'll have the unit mix, we just won't have the rents. We won't have occupancy information either, because almost all of these fully affordable properties, there's a wait list to get in. So occupancies often run at 100%. We just won't have the rental rate history, but we'll have, again, all the property characteristics, the demographic information. I just didn't want to use this one as an example because it didn't show off all of the capabilities of our data.
Makes sense. You know, one of the reasons and one of the purposes for bringing in Chris is not only he's just such a wealth of knowledge, but also for simply because he has this great tool that, you know what, yeah, it might be a little expensive, and Chris, you can take us through that. But remember, everybody, you are using other people's money. Millions of dollars you are collecting of other people's money. And so you better have a tool instead of doing Google searches, which may be part of somebody else's thought, maybe some crime statistics, which may not be accurate. You have a tool here that Chris is involved with and there's other out there, of course. And Chris is just such an expert on pulling this data, and, you know, we're just so grateful for that. But when you're talking to your investors, I think this is such a great tool, and while it may be a little expensive, if you know the markets that you're working in, why wouldn't you want to know all of those owners and be able to contact them and build a relationship? And it just brings all of your information closer to you than out in the atmosphere of a Google search. So Chris, real quickly, we're not here to sell this. We are actually just here so that Chris can tell us all about the markets. But if somebody were wanting to take a look at this for their business, what would something like this cost?
Yeah, so our data and our access to our platform is sold on a subscription basis, market to market. Each market is $3,500 a year, or about $300 a month. And if you're a national player, if you're in more than 8 markets, our national subscription is $25,000 a year. And as Julie said, it is an expensive product. It is an expensive data subscription. But I would just reiterate what Julie has said. When you're buying deals with other people's money, and you're buying multi-million-dollar deals, the cost pays for itself with 1 or 2 or 3 deals. And you're not going to get much positive feedback from your investors if you say, oh, Chris Nebenzahl said it's a great deal in a great market, or Julie Peterson said it's a great deal in a great market. But you will get that feedback, and you will get that investment capital when you say, look, I've got data to support why this market has done what it's doing and why we expect it to continue to do, why we expect to meet our pro forma numbers, why we expect to return or to provide the return on your investment that we're promising or we're forecasting. Data, and it's not just in real estate, it's in everything that we do. You can think about Amazon, you can think about Google. The world that we're living in is more and more focused on data, and this is just a piece of it. And for many of us investors, real estate data is absolutely critical. Again, because the smartest real estate investor in the world is not just going to be able to pick a deal out of his or her hat and say, oh, come follow me on this deal. But if you've got data and concrete information behind it, it'll be really valuable.
Absolutely.
So with that, I know I'm kind of over my time, well over my time. Julie, you have
Chris,
my contact information. I'll put it in the chat.
Yeah, can you bring up the your last or your first? Do you have a contact slide for
I
everybody
do.
so that they have that? Yeah, that would be great. And
Yeah.
while you're doing that, is there a minimum term for subscription?
Our subscriptions last a year.
Okay.
If there's an issue with how you're using it or anything, we can always work with our customer service department. If you want to get out early, but the subscriptions run on a yearly basis.
Yeah, excellent. All right. Do you have that? Do you have that one? There we go. So let's make sure that Chris has his contact information up there. Chris is so gracious with his time, obviously the last 2 weeks. Thank you so much, Chris. But also he makes himself available to the folks here on Zoom at 8. So if there are questions, as always, don't overuse your contact with Chris. He's a busy guy. He does this in other asset classes. But if there are some questions you have that are, high level where, you can't get that, I think that, Chris would be more than willing to work with you guys on that. So thank you so much, Chris.
Absolutely. Yeah, please reach out. I'm happy to set up a phone call and chat through markets. I'm happy to pull some data for you. Please don't hesitate to reach out with any questions.
Okay.